In this mini lecture, we talk about what messages we can take from the information in the statement of cash flows. The discussion is then illustrated by referencing the Woolworths statement of cash flows and the story that their cash management during the year. Let's talk in more detail about the three sections. Here we're talking about cash flow from operating activities. Now, operating activities roughly equates with the process of generating a profit, or if it's bad, of generating a loss. And so you can say roughly this statement should tell a parallel story to that of the income statement. The income statement is about performance. It tells us if we're making a profit. If you're making a profit, let's look at this logically. The cash inflows on the left from sale of goods and services to customers should be greater than the cash outflows on the right to employees for wages or to suppliers for inventory or to others for expenses. It seems logical that the cash inflows from customers must be greater than the cash outflows for all of our expenses, consistent with making a profit. And so if you look at your statement of cash flows and you see that the net cash position from operating is substantially different from what the income statement is telling you in terms of profit, or alternatively of loss, then you should ask the question, why are they so different? Now, there's numbers of reasons why cash accounting will be different from accrual accounting. We already know that. One of the big reasons is because of the expense depreciation, which is a non-cash expense, but it does reduce profit, and so we would always expect that profit will be less than the net cash flows from operating, if only because of the big non-cash expense depreciation. Let's focus on this discussion about the difference between the cash flow from operations and profit. You'll see when you look in your Woolworths statements that there is a reconciliation between the profit figure as reported in the income statement and the net cash flow from operations, which is reported in the statement of cash flows. And when you look at that reconciliation, you will see that the largest difference comes from the non-cash expense, which is depreciation. Now think about this logically. When we calculate the profit on an accrual basis, one of the expenses, amongst many, that we deduct is that of depreciation. Now you saw from our previous discussion that we calculate depreciation based on a formula, and the formula applies to a purchase of an asset which may have been made a number of years earlier. So there's no cash flow associated with the expense depreciation. However, that expense does reduce profit, and that is an accrual basis of accounting. It's matching the expense of using the asset which we purchased some years earlier. And so expect that the cash flow from operations will be different from the cash flow from profits. But logically, we should always expect that the cash flow from operations will be greater than the net profit. And if it's not, we should ask the question as to why, and we should go and explore and see if we can find the answer about what's going on. It's unusual if that's the case. Here are other reasons why the cash flow from operations may be different from the profit figure. When we sell our products, we don't always receive the cash at the same time. And so while selling the product or service starts the cash cycle, what we then have to do is convert those sales to cash. And so we can reconcile the differences here by looking at, on the balance sheet, at the accounts receivable figure when we started the year and the accounts receivable figure when we closed the year and the sales figure. And using those three figures, we can work out how much cash we received from customers as opposed to the top figure there, which is the actual sales which were recognised and illustrated as the top line in our income statement. The flip side of this is a similar calculation with respect to purchases and accounts payable. If we are allowed credit by our suppliers, then it makes very good business sense for us to pay for our expenses using the credit terms, which are most often 30 days. So we'd be paying for our expenses and our purchases 30 days after we've actually received and used those goods or services. And so again, you have a difference between the total of expenses that are booked into your income statement and the cash flow which we pay out to our creditors. And the logic here is the same. You can take the purchases figure and work out the difference between the accounts payable at the start and the accounts payable at the end, and that will then give you the difference, which will be the cash paid to suppliers. And so we understand now that there are at least 3 quite regular ways that cash flow will be different from profit. Here's a 4th one, other expenses. And the big other expense here is the one that we've just discussed before, which is depreciation expenses. But there are other non-cash items as well that may play into this discussion. So now let's turn to cash flow from investing activities. Here we're looking at selling non-current assets. So these will be inflows that come in from the sale of property, plant and equipment or any other long-term assets, from the sale of long-term and short-term securities, and from collecting any loans which we were holding in the way of investments. So these will be inflows from investing activities. Offsetting that will be the outflows where we purchase property, plant and equipment, and any other long-term assets, where we perhaps purchase long or short-term marketable securities, or where we make loans. The net impact of that is that we would hope that our stock of non-current assets, investment assets, will increase. We'd like to have more of them at the end of the year than we had at the start of the year. That's a signal of a growing business implementing its strategic plan. And finally, from financing activities, the 3rd area in the statement of cash flows. We have inflows, which will come from raising more equity from the sale of shares or from issuing debt. So either equity investors or debt investors will provide us with their funds for the business to invest and to operate and hopefully to grow the value of their investment. Offsetting that will be outflows, which may be used to buy back shares, perhaps, or to repay debt, or to pay dividends, which is the reward to the providers of equity, that's shareholders. Now, when you examine the Woolworths statement of cash flows, you need to start asking questions, and these are pretty standard questions that you could ask of any statement of cash flows. Okay, so the first thing to do is to ask, where does their cash flow come from, mainly? And a good answer to that will be from operations. If the operating part of your business is not generating a positive cash flow, then in the long term we're in trouble. In the short term we can cover that, but in the long term we're in trouble. The next question then is, well, let's have a look and see where they spend it. So there are lots of signals that you can pick up here that you might think are good signals or bad signals, and here are just a couple of them. The first good signal is that operating cash flow is greater than profit. And we've already discussed why we expect this. It's because of the non-cash expenses, of which depreciation will usually be the biggest. Why is that a good thing? Well, because it tells us that the business is generating a positive cash flow from its everyday operations. The next question you'd ask is, what are they doing with their non-current assets in the business? Well, a good signal is that they're increasing them. A bad signal is that they're selling them off. Most of us understand that if we have to sell off our assets, it's because we're experiencing difficult times. And so observing a decreasing total of non-current assets is something that should cause us to be worried. And then the final question, what financing activities can we see? Are they raising more funds, more equity or more debt? And how do we interpret them? Now, when you look on the balance sheet, you'll be able to see that shift. You'll be able to see if they're raising more equity. You'll see that the equity portion of funding is now becoming greater relative to the debt portion. If they're raising more debt, you need to ask yourself, are they increasing the level of risk in their operational environment? Now, I'll direct you to this the statutory reporting requirements. AASB 107 defines what we are allowed to and required to put into the statements of cash flows. And so there you'll see the structure always has to be in those three categories: operating, investing and financing. Businesses are required to provide a reconciliation of the cash flows from operating to the net profit, and that's a very revealing statement. You should always make a point of going and having a good look at that and understanding what it's telling you. And this AASB 107 will also define any other reporting requirements that they need to inform you about, particularly about non-cash financing and investing activities. So keep in mind the cash flow statement won't reveal those, but AASB 107 says, aha, here it is, you must reveal them even if they are non-cash activities.